Gold prices approached $5,000 per ounce during early 2025, representing a significant increase from levels observed in previous years. This price movement generated discussions about whether the advance reflects speculative excess similar to historical asset bubbles, or whether it represents structural repricing driven by monetary and geopolitical factors. This analysis examines the characteristics of the current gold price environment, compares these characteristics to historical speculative episodes, and evaluates the structural factors that may be influencing precious metals valuations. The objective is to distinguish between price movements driven by speculative momentum versus those reflecting fundamental shifts in monetary conditions and institutional behavior. The analysis will proceed in 5 parts. First, the confirmed price data and historical context. Second, the characteristics of speculative bubbles based on historical precedents. Third, structural factors including sovereign debt levels, central bank behavior, and monetary policy conditions. Fourth, indicators of retail versus institutional participation. Fifth, scenario mapping based on different paths for monetary policy, debt dynamics, and geopolitical conditions. Gold traded near $2,000 per ounce in early 2024 before advancing toward $5,000 by early 2025. This represents an approximate 150% increase over a 12-month period. For context, gold traded around $1,800–$900 in 2021–2022, declined to approximately $1,600–$1,700 in late 2022, and then began a sustained advance through 2023 and 2024. Central bank gold purchases reached elevated levels during 2022–2024, according to World Gold Council data. Net purchases by official sector institutions exceeded 1,000 metric tons annually during this period, representing the highest sustained buying in decades. Major purchasers included central banks in China, India, Turkey, and several other emerging market economies. These purchases occurred consistently across quarters rather than concentrated in specific periods. Global sovereign debt levels continued expanding during 2020–2025. United States federal debt increased from approximately $28 trillion in early 2021 to over $36 trillion by late 2024. Other major economies, including Japan, European nations, and China, also recorded increasing debt to GDP ratios. Combined with persistent fiscal deficits, these debt levels raised questions about long-term debt sustainability and potential monetary responses. Real interest rates, calculated as nominal yields minus inflation expectations, remained compressed or negative during extended periods from 2020–2024. While nominal rates increased during 2022–2023 as central banks raised policy rates, inflation also rose, keeping real rates near zero or negative for much of this period. Real rates turned modestly positive in some markets during late 2023 and 2024, but remained below historical averages. Retail participation in gold markets, measured through small investor flows into gold ETFs and retail bullion purchases, increased during the 2020–2024 period, but remained below levels observed during previous peaks. For example, retail participation during the 2011 gold peak, when prices reached $1,900, showed substantially higher public interest measured through media coverage, ETF inflows from retail channels, and coin sales compared to 2024–2025 levels. Historical speculative bubbles display consistent characteristics across different markets and time periods. Understanding these characteristics provides a framework for evaluating whether current conditions match bubble patterns. Historical examples include the Dutch tulip mania of 1636–1637, the South Sea bubble of 1720, the 1920s stock market bubble, the Japanese real estate and equity bubble of the 1980s, the dot-com technology bubble of 1999–2000, and the U.S. housing bubble of 2004–2007. Common characteristics of speculative bubbles include rapid price acceleration that exceeds fundamental justification, widespread public participation driven by fear of missing gains, media coverage that shifts from skeptical to promotional, credit expansion funding speculative purchases, new paradigm narratives justifying unprecedented valuations, and disregard for traditional valuation metrics. Bubbles typically feature parabolic price charts with near vertical ascent in final stages, extremely high trading volumes, and sentiment surveys showing extreme optimism. In the Dutch tulip mania, rare tulip bulb prices increased exponentially over months before collapsing. Ordinary citizens mortgaged property to purchase bulbs, and bulbs traded in taverns with no delivery requirement. The South Sea bubble involved shares of the South Sea Company rising from $128 to over $1,000 within months, driven by speculation about future trading profits that never materialized. The 1920s stock market bubble saw stocks valued at unprecedented multiples of earnings, while margin debt reached record levels, with widespread public participation through new investment trusts. The dot-com bubble featured technology stocks trading at valuations with no historical precedent, justified by narratives about new economic paradigms where traditional metrics no longer applied. Initial public offerings for companies with minimal revenue rose 501,000% on opening day. Retail participation reached extreme levels with individuals quitting jobs to day trade. Media coverage was overwhelmingly promotional, with skeptics marginalized. The housing bubble of 2004-2007 involved property prices rising far beyond rental values or income fundamentals, funded by expanding mortgage credit with declining lending standards. Public participation was near universal, with widespread belief that housing prices could not decline. Media and industry professionals promoted continued appreciation as inevitable. Comparing these historical patterns to current gold market conditions reveals significant differences. Gold's price advance from $2,000 to $5,000 occurred over approximately 12 months, rather than the condensed 3 to 6 month parabolic rises typical of late-stage bubbles. Trading volumes in gold futures and ETFs increased but did not reach the extreme multiples of normal activity seen in historical bubbles. Retail participation, while present, remains limited compared to institutional and central bank activity. Gold does not dominate casual conversation or media coverage in the way housing dominated 2005-2006 discussion, or technology stocks dominated 1999-2000 coverage. Valuation metrics for gold differ from equity or real estate bubbles, since gold generates no cash flows and has no fundamental earnings multiple. However, gold can be evaluated relative to money supply, debt levels, or other assets. The ratio of gold prices to money supply, to total sovereign debt, or to equities provides historical context. Even at $5,000, gold represents a lower percentage of global financial assets than during the 1980 peak, when gold reached $850, equivalent to approximately $3,500 in 2025 dollars, while total financial assets were far smaller. Current gold market capitalization remains a small fraction of global equity markets, fixed income markets, or real estate values. Credit expansion to fund gold purchases remains limited. Unlike housing or stocks, where margin lending and leverage increase dramatically during bubbles, gold purchases largely occur with cash or modest financing. Futures market open interest increased, but without the extreme leverage ratios that characterize late-stage speculation. Structural factors distinguish current conditions from purely speculative environments. Sovereign debt levels across major economies reached peacetime records as percentage of GDP. United States federal debt exceeded 120% of GDP, similar to levels seen only during World War II. Japan's debt exceeded 250% of GDP. European nations carry debt ratios of 80–140% depending on the country. China's combined government and corporate debt exceeded 300% of GDP. These debt levels create constraints on monetary policy. Central banks face tension between controlling inflation through higher interest rates versus managing debt service costs. Higher rates increase government interest expense, worsening fiscal deficits and potentially requiring additional borrowing. This dynamic creates pressure for financial repression, where real interest rates are kept negative or low to reduce the real burden of debt over time. Financial repression benefits debtors, particularly governments with large debt burdens, by allowing inflation to erode the real value of fixed-rate debt. However, financial repression harms savers and creditors by providing returns below inflation rates. In such environments, hard assets that cannot be debased serve as alternatives to currency or fixed income holdings. Central bank gold purchases during 2022-2024 occurred in the context of several geopolitical developments, including sanctions imposed on Russia following the 2022 Ukraine conflict, which involved freezing foreign exchange reserves and excluding Russian institutions from the SWIFT payment system. These actions demonstrated that foreign exchange reserves held in Western currencies could be immobilized during geopolitical conflicts. This precedent influenced reserve management decisions by central banks seeking to diversify away from assets subject to potential sanctions. Gold represents neutral reserve asset without counterparty risk or reliance on any specific country's financial system. Unlike treasury bonds, which represent claims on a specific government, gold serves as a universally recognized store of value without political dependencies. For central banks concerned about geopolitical fragmentation or potential asset freezes, gold provides insurance against these scenarios. The accumulation pattern differs from speculative buying. Central banks purchased gold consistently across quarters rather than chasing momentum during rapid price increases. Purchase volumes remained relatively steady even as prices rose, indicating strategic allocation decisions rather than momentum-driven speculation. Central banks typically acquire gold through gradual accumulation rather than large one-time purchases, minimizing market impact and avoiding telegraphing intentions. Monetary policy conditions during 2020-2024 created environment conducive to hard asset appreciation. Extended periods of negative real interest rates, meaning nominal returns below inflation, made non-yielding assets like gold relatively more attractive. When treasury bonds yield 4% but inflation runs at 5%, real returns are negative. Gold, which yields nothing but also cannot be debased, becomes competitive on a relative basis. The relationship between real yields and gold prices shows historical inverse correlation. When real yields decline or turn negative, gold typically appreciates. When real yields rise to positive levels exceeding 2 to 3%, gold faces headwinds as interest-bearing alternatives become more attractive. During 2020-2024, real yields remained mostly below 1% and frequently negative, providing supportive conditions for gold. Retail participation indicators suggest limited public involvement compared to historical bubbles. Google search trends for buy gold remained well below 2011 peak levels. Gold ETF flows showed mixed patterns with some retail outflows, even as institutional accumulation continued. Coin sales at retail dealers increased but did not approach the shortages and premiums seen during 2008, 2009, or 2020, when retail panic buying overwhelmed supply. Media coverage of gold increased but remained predominantly analytical rather than promotional. During bubbles, media coverage shifts from questioning sustainability to celebrating gains and encouraging participation. Coverage in 2024-2025 included substantial skeptical commentary questioning whether gold could sustain $5,000 levels, contrasting with uncritical promotion typical of late-stage bubbles. Sentiment surveys of investors showed elevated optimism toward gold, but not the extreme readings associated with bubble peaks. Surveys measuring bullish sentiment on gold reached 65-70% bullish readings, elevated but below the 85-95% readings that typically mark bubble extremes. Significant minority of analysts maintained bearish or neutral views, unlike bubble environments where contrarian views nearly disappear. Comparison to past gold cycles provides additional context. Gold experienced significant rally from $35 in 1971, when the dollar's gold convertibility ended to $850 in January 1980, a 24-fold increase over 9 years. The final advance from $500 to $850 occurred in approximately 12 months from late 1979 to early 1980, driven by inflation fears, Iranian hostage crisis, Soviet invasion of Afghanistan, and widespread public participation. The 1980 peak featured gold trading pits with standing room-only crowds, coin dealers with lines around the block, and media coverage predicting $2,000 to $3,000 gold. The current advance from $2,000 to $5,000 represents 2.5-fold increase, substantial but far smaller than the 24-fold rise from 1971-1980, or even the final 70% rally from $500 to $850. Public participation remains modest rather than frenzied. Physical premiums exist but remain within normal ranges rather than the extreme premiums of 1980 when physical coins traded 20–30% above spot prices. Gold declined from $850 in 1980 to approximately $250 by 1999 to 2001, losing 70% of its value in real terms over 2 decades. This decline occurred as inflation was controlled, real interest rates rose to positive levels, and confidence in fiat currency systems strengthened. The subsequent rally from $250 in 2001 to $1,900 in 2011 represented recovery and new highs driven by financial crisis concerns, quantitative easing programs, and sovereign debt worries. The decline from $1,900 in 2011 to $1,600, $1,700 in 2015-2016 resulted from rising real yields and restoration of confidence in central bank policies. Multiple scenarios exist for how gold prices may evolve depending on monetary policy paths, debt dynamics, and geopolitical developments. Scenario A involves stabilization and consolidation. In this scenario, gold prices stabilize in the $4,500 to $5,500 range following the initial advance to $5,000. Central banks continue gradual accumulation, but at measured pace. Retail participation increases modestly but does not reach extreme levels. Monetary policy achieves balance between inflation control and debt management, with real yields remaining near zero to slightly positive. Fiscal deficits narrow modestly, reducing pressure for monetary financing. Geopolitical tensions remain elevated but do not escalate to major conflicts. Gold maintains value, but does not experience additional rapid appreciation. Some profit-taking occurs after the substantial gains, creating volatility but not collapse. The advance from $2,000 to $5,000 is consolidated through multi-year trading range. Conditions required for Scenario A include stable inflation near 2–3%, nominal yields that keep real rates near zero, continued but not accelerating central bank purchases, absence of major geopolitical shocks, and moderate rather than extreme retail participation. Indicators include gold volatility declining from peak levels, trading volume normalizing, physical premiums remaining modest, ETF flows stabilizing, and media coverage becoming less prominent. Scenario B involves continued appreciation driven by structural factors. In this scenario, gold advances from $5,000 towards $7,000, $8,000 over subsequent years as structural pressures intensify. Fiscal deficits remain large despite periodic attempts at reduction. Total sovereign debt continues growing faster than GDP. Central banks face renewed pressure to maintain accommodative policy to manage debt burdens. Real yields remain suppressed or turn negative again as inflation proves persistent. Geopolitical fragmentation accelerates with expanded use of financial sanctions, prompting broader central bank diversification into gold. Retail participation increases gradually as the long-term trend becomes established. However, the advance remains orderly without parabolic acceleration or public mania. Gold continues serving as monetary insurance rather than speculative vehicle. Conditions required for scenario B include persistent fiscal deficits exceeding 5% of GDP, inability to reduce debt to GDP ratios, inflation remaining above central bank targets, geopolitical tensions escalating, and continued central bank gold accumulation. Indicators include rising debt levels, negative or near zero real yields, increasing central bank purchase volumes, expanding sanctions use, and gradual rather than explosive retail participation. Scenario C involves speculative blow-off and subsequent correction. In this scenario, the advance from $5,000 accelerates into parabolic rally toward $8,000, $10,000 within 6 to 12 months. Retail participation surges as public fear of missing gains overcomes caution. Media coverage becomes overwhelmingly promotional. Physical premiums explode as delivery demand overwhelms supply. Leverage increases as investors borrow to purchase gold. Sentiment reaches extreme optimism with nearly universal bullish views. The rally culminates in near vertical price advance followed by sharp reversal. Gold declines 40–50% from peak over subsequent 12–24 months as speculative positions unwind. The correction may be followed by renewed advance after excesses are cleared, but initial decline inflicts substantial losses on late entrants. Conditions required for scenario C include rapid acceleration of price appreciation, surge in retail participation metrics, extreme media promotion, widening physical premiums, increasing margin debt and leverage, and sentiment reaching euphoric levels. Indicators include parabolic price charts, explosive trading volumes, extreme sentiment readings above 90% bullish, physical premiums exceeding 15 to 20%, and media coverage transitioning from analytical to promotional. The implications vary across participants. Long-term holders who accumulated gold before the advance experienced substantial gains. Their decisions involve whether to maintain positions viewing current levels as early stage of longer cycle or to reduce exposure after significant appreciation. Central banks accumulating gold for strategic reserves likely maintain positions regardless of short-term price moves, as their objective involves diversification rather than profit maximization. Retail investors entering near current levels face different risk-reward profile than earlier entrants. If scenario A unfolds, returns may be modest with potential for temporary drawdowns. If scenario B develops, further gains are possible, though at slower pace. If scenario C occurs, late entrants face significant loss risk. Position sizing and risk management become critical for participants entering established trends. Mining companies benefit from higher gold prices through improved profitability and higher equity valuations. However, they also face questions about sustainability and appropriate capital allocation. Expanding production during price peaks risks creating excess capacity if prices subsequently decline. Disciplined capital allocation prioritizes returns over production growth. What remains uncertain includes the trajectory of fiscal policy and whether governments will implement meaningful deficit reduction, the path of inflation, and whether it remains persistently elevated or returns to low levels. Central bank policy responses to competing pressures of inflation control and debt management, geopolitical developments and their impact on reserve asset preferences, and the timing and magnitude of retail participation if it materializes. Key variables to monitor include sovereign debt levels and deficit trends, real interest rate movements, central bank gold purchase volumes, retail participation indicators including ETF flows and coin sales, physical premium levels, trading volumes and volatility, sentiment survey readings, and media coverage tone. Changes in these indicators signal which scenario is developing. The distinction between structural repricing and speculative bubble matters for understanding sustainability. Structural repricing driven by fundamental monetary and geopolitical factors can sustain over extended periods, though with volatility. Speculative bubbles driven by momentum and emotion terminate abruptly, typically retracing most gains within 1–2 years. Current conditions show mixture of structural factors and speculative elements. Structural factors include elevated debt levels, financial repression dynamics, geopolitical fragmentation, and central bank diversification. Speculative elements include rapid price appreciation, increasing media attention, and growing retail interest. The balance between these factors will determine whether current prices represent sustainable revaluation or temporary excess. To summarize confirmed elements, gold advanced from approximately $2,000 to near $5,000 during 2024-2025. Central banks purchased over 1,000 metric tons annually during 2022-2024. Global sovereign debt reached peacetime record levels exceeding 120% of GDP in major economies. Real interest rates remained compressed near zero or negative for extended periods. Retail participation increased but remained below historical bubble peaks. Physical premiums widened but stayed within normal ranges rather than reaching extreme levels. What remains uncertain includes whether fiscal deficits will narrow or persist, the inflation trajectory and monetary policy response, the pace and scale of future central bank accumulation, potential geopolitical developments affecting reserve preferences, and whether retail participation will surge or remain moderate. The variables that matter most include real interest rate direction, sovereign debt sustainability, central bank purchasing patterns, retail participation levels, and geopolitical stability. These factors will determine whether gold sustains current levels, advances further, or experiences correction. This analysis distinguishes between characteristics of speculative bubbles and structural repricing. Current conditions show elements of both, requiring ongoing monitoring of key indicators to assess which forces dominate. We will continue tracking confirmed developments in monetary policy, central bank behavior, and market participation patterns.